What's good, guys? Welcome back to the ICT Ninja Mentorship. This is episode 2. So today we're diving into one of the most important concepts in trading, which is liquidity. So if episode 1 was about setting the stage, episode 2 is where we start building the foundation. So liquidity is the fuel of the market. So without it, price simply doesn't move. Every rally, every sell-off, every wick that takes you guys stops whenever you guys are in a trade, it's all driven by liquidity. So think of it like this, guys. The market isn't random. Algorithms aren't just printing candles for fun. They are targeting money. Pools of orders sitting above equal highs, below equal lows, or clustered around obvious retail stop zones such as trendline liquidity and stuff of that sort. So it's literally the heartbeat of price action, guys. So most traders get caught up in reacting to moves without even understanding why these moves happen in the first place. But once you guys actually understand liquidity, you'll stop chasing price and you'll actually begin anticipating where it needs to go next. So in this episode, guys, we're going to be breaking it all down step by step. What liquidity is, why it matters, how to read equal highs and lows as potential draws or magnets for price. So by the end of this lesson, you'll understand the market completely differently. So lock in, guys, follow along, and let's get started with liquidity 101. So before we actually use liquidity, guys, let's just clearly define it and what it is. So liquidity is simply pools of orders resting in the market. Think of it as fuel that powers every single price move in the market. But where do we find this liquidity? It sits above highs, below lows, and in obvious retail stop zones such as resistance, support and resistance and stuff of that sort. Every time traders place a stop loss, that's literally liquidity for the market to grab. So big players such as banks, funds, algorithms, they need that liquidity to get their massive orders filled. They can't just click buy and sell just like retail traders can, like us. So these guys require counterparties, and those counterparties are sitting at your retail stops. So when you guys see equal highs or equal lows, don't think of them as resistance or support. Think of them as targets, as draws on liquidity, because that's where the money is, and that's exactly where the market is going to be drawn to them. So now that we've defined liquidity, guys, let's talk about why liquidity actually matters. So guys, price does not move randomly. Every single push in the market is driven by the hunt on liquidity. So think of it like this, guys. Big traders like institutions, algorithms, they can't just click buy and sell like us retail traders. Their orders are huge. So they need someone on the other side of the market to counteract or counterparty their trade. But where do they actually find that liquidity? It's at obvious places such as stops. So equal highs, equal lows, retail breakout trades. All those orders are getting stacked up and waiting to get triggered, and that's the fuel for smart money to enter the market. So the markets run the stops, they then grab the liquidity, and only then they can deliver it to the true targets. So guys, if you've ever wondered why you're in a trade, for example a buy, and price suddenly stops you out at a certain low and then runs to buy side liquidity, that is literally liquidity taking place. So your guys' edge as smart money traders is learning to think like the algorithm. You stop reacting to price and start anticipating where liquidity sits. So once you guys understand where the stops are, that's exactly where the market is going to be driven to next, aka the drawn liquidity. So liquidity isn't just part of the market, it's the actual engine of the market. And once you understand this, you'll never see price action the same way again. Right, guys, so if liquidity actually drives the market, the question becomes, where does liquidity actually sit? So you guys want to be thinking of this like a map. So certain zones in the market act like magnets for price because that's exactly where stop loss orders cluster. Let me just quickly break it down for you guys. So first, the classic equal highs and lows. So when price creates a double top or a double bottom, retail traders say that as strong support or resistance. but to us it's just a liquidity pool. Buy stops stacked above equal highs, sell stops stacked below equal lows. So the next one is session highs and lows. So that's where you get the London session, the Asia range, the New York session. Each one leaves behind obvious draws on liquidity, highs and lows. So the algo uses these as reference points to raid liquidity before making the real move. Then there's internal range liquidity. That's when price consolidates inside of a certain range, and then liquidity builds up at those mid-range highs and lows. So the market loves to run those before continuing in the true direction. And finally, obvious retail patterns, so trendline touches, breakouts, double tops and bottoms. So these aren't reliable reversal patterns, they are liquidity signals. So when retail piles in, puts stops at obvious places, that's exactly where the market runs. So here's the shift in mindset, guys. So instead of seeing these areas as strong levels, you want to start seeing them as liquidity magnets or draws on liquidity. So every move, every session, the algo is hunting these liquidity pools. So once you learn how to map liquidity, you'll know where price is likely to reach before it even gets there, guys. Now let's talk about one of the clearest forms of liquidity, so equal highs and equal lows. So when price leaves behind two or more touches at the same level, retail traders see that as strong support or resistance. They think if it's held there before, it'll hold again. But here's the truth, guys. Equal highs and equal lows are literally just magnets. Every time retail enters at those levels, they place stops at the highs above those equal highs or below those equal lows, depending in their trade direction. So this creates a cluster of liquidity waiting to be taken. For example, when you see equal highs, that's resting buy side liquidity. So algos know when retail traders are shorting resistance and placing their stops above those highs right here. So price runs those highs, takes the stops, and then moves lower. So it's literally the opposite with equal lows, sell side liquidity. Price dips below to take out those stops and then grab the sell side liquidity, and then it reverses back higher. But here's a key mindset shift, guys. So you don't want to see equal highs and equal lows as strong levels. Instead, you guys want to be seeing them as resting pools of orders, fuel for the next move. So once you guys flip that perspective, you'll stop seeing liquidity and you'll start trading alongside the algorithm. So once you guys flip that perspective, you'll stop being the liquidity and you'll start trading alongside the algorithm. Now let's talk about London session highs and lows, which are one of the most important draws on liquidity in terms of ICT concepts. So every single day, guys, the London session range is 2 a.m. to 5 p.m. Eastern Standard Time. So every single day the market pauses a swing low and a swing high during this time range from 2 a.m. to 5 a.m. AST. Now that's not random, guys. That is the market setting up pools on liquidity or draws on liquidity for the New York AM session to open, come take out that buy side or sell side, and then literally reverse and go in the opposite direction. So the London high becomes a resting place for buy side liquidity. Traders who shorted during London will have their stops above this high. So this becomes a clean pocket of liquidity. London low again is the opposite. It's where sell side liquidity is building up, stops from buyers sitting below this low right here, and breakout sellers are ready to sell into that move if price does break below this low right here. Now here's why it matters for us. When the New York opens, price will often target, raid or respect these London levels. So they basically set the trap line for the New York kill zones, which is these lines right here. So once the New York AM session opens, again, could either raid the high of the London session or the swing low of the London session, and then reverse depending on the narrative for the day. So when you're trading in the AM or PM macro windows, always mark out the London high and low first. I mean, if you're trading in the PM macro window, most of the time London low and London high is going to be already taken during the AM session. But they act as like magnets, guiding where liquidity runs are most likely to happen. Okay, so next guys, we'll break down the Asia session. So the Asian range typically runs from around 7 PM Eastern Standard Time to 12 AM Eastern Standard Time. So during this time, volatility is extremely lower compared to London or New York, but it's still extremely important. But why is that? It's because Asia sets the initial swing high or swing low for the day. So think of it like an accumulation phase. The market is going to be building a box of price action that later sessions, such as London session, New York AM session, will target the pools of liquidity within this box or range, so the swing high and the swing low. So when we get in Asia high or Asia low, these are reference points. So above Asia high, we have resting buy stops, and below Asia low, we have resting sell stops. But what usually happens, so the New York and London session will later come and raid these levels. So they'll take out Asia highs or lows for fuel to do the real move. So just because the Asia range is typically a low volatility environment, don't think of it as just quiet or sideways trading. It's actually where the trap gets set. So the Asia range is the foundation that London and New York will use to engineer bigger moves. So always keep it marked on your chart, guys, because price will often come and raid these Asia highs and lows before making its real run. Okay, so now let's talk about one of the most important liquidity reference points that you'll use every single day, the previous day high and low. So this is very simple to plot, guys. All you guys need to do on TradingView is go to your daily chart, find yesterday's candlestick on the daily chart, and literally just get a horizontal ray or a trend line and mark a straight horizontal line from the candlestick's high of yesterday's trading and the candlestick's low of yesterday's trading, and that's it. But don't let the simplicity fool you, guys, because these levels carry massive weight in how price moves intraday. Now, why is that? It's because that's where huge liquidity is resting. So above previous day high, you have massive orders of buy stops. Every trader who shorted within yesterday's range, most of them will still have their stop at yesterday's swing high of yesterday's candlestick. So every single breakout trader who's told to buy the breakout is also stacking these buy orders there as well. So that creates a massive liquidity pool. Now below previous day's low, it's the same thing. Sell stops. Traders who went long yesterday, stops are under that swing low most of the time, and breakout traders are waiting to sell a breakout. Again, another liquidity pool. Now here's the key. Institutions know this, algorithms know this, so these levels become magnets for price. More often than not, in today's session, you'll see the market reach for either the previous day high or previous day's low before making its real move. So as an ICT trader, guys, your job isn't to just blindly buy or sell at these levels. Your job is to first recognize the liquidity, to understand that price is drawn to these highs and lows, because that's exactly where orders are resting. Once the liquidity has been taken, the market will reverse and deliver to the true target and the next drawn liquidity. That's why marking out previous day high and previous day low is part of my daily routine. So every single morning I know exactly where they are because they give me a framework. So if price is trading below yesterday's swing high, I know that buy side liquidity is built up above the swing high of yesterday's trading. If we're trading above yesterday's low, I know that sell side liquidity is resting below yesterday's low. And this is one simple step. Drawing two lines immediately shifts you guys out of the retail mindset of random candles and into the smart money framework. It gives you a daily roadmap of where the market wants to go and what it wants to take along the way. Alright guys, so that wraps up episode 2 of the ICT Ninja Mentorship Liquidity 101. So we've covered why liquidity is the fuel of the market and where it typically rests. So equal highs, equal lows, session highs and session lows. So in the next episode, we're going to be breaking down market structure basics. So break of structure versus market structure shift, and how to actually read the story of price. Also guys, if you want to go a bit deeper, you can watch me trade live every single day and connect with other serious traders inside of my Discord community. So the link to join there is inside of the description of this video. So I'll see all of you guys in episode 3.